with silver, like silver in the earth is about roughly 8 times more prevalent. Like there's about 5 billion ounces of gold, a little bit over 5 billion ounces of gold in existence. And in terms of mining, the estimate is about 40 billion ounces of silver has been mined. But what happens with silver is its price is so cheap, and it's used all the time for any type of application. It has many, many different uses, and it actually gets discarded. So it gets consumed and used up, and it's in such small amounts. Like the company I used to work for would use like milligrams of silver paste onto microchips, and we'd go through we would go through a lot of silver. let's leave it at that. We would go through like a lot of silver each year, and what ends up happening is, you have these little bits of silver, and it's not economical to recover them, so they go into landfills or they go wherever because it doesn't make sense to cover that up. So this is actually one of the other, I guess, very unknown things, because you see a lot of silver jewelry around. But people know that, silver is cheaper than gold. And, right now, if you walk into a jeweler, that's the price. Silver is a lot cheaper. You can get about, for 70 troy ounces, which is about 30 grams of gold, you can only get one troy ounce of gold. Or I might have said that a little bit off, but where we're at really is the above ground stock of silver is somewhere between 1 and 2 billion ounces. So with gold at 5, there's less silver because for many, many years industry has been consuming it and consuming it and consuming it many times over the mine production rates. So a lot of folks talk about this. I think Ted Butler in his column probably that's one of the ones I follow. And there's also another fellow, Tom Szabo, on silveraccess.com. And actually I like reading Tom's work because he actually believes that the prices are not manipulated. And he's one of the folks that offers, very I would call them logical arguments for sure. But they don't really hold water when you really start looking into all the details with the market.
When you start weighing their arguments against the insurmountable mountain of evidence on the other side, it's really hard to reconcile them. I mean, it's almost impossible not to come out on the side of this is definitely manipulated.
Right.
There's so much evidence. It's crazy.
So in the article, what I try to outline is pretty much how the scheme works. There's basically 4 steps, and you have to understand how the futures markets work. So I have those linked in there as well. But it's pretty much, it goes down to, and it's actually, they talk about all the time about how, it can't occur because it's too complicated. But it's actually very, very simple. It's just the matter of the bullion banks, selling the gold into the market at spot price, and then this metal eventually leaves the exchange. But what they also try to do is basically pile more and more paper contracts on top. So one of the things that will be kind of interesting to see is, when these future markets go down, they have all these claims for this gold. Because, what are derivatives? Derivatives are just bets on underlying assets. They're not the actual asset themselves. So, like when you get if you try to take delivery on gold, say, an October contract, you're basically saying, well, I'm putting up this money right now, and when it's mined or in October, you give it to me. And but what a lot of folks are seeing is, there's counterparty risk. What if that gold just doesn't exist, or if the exchange gets broken by that point in time. So that's something to really kind of watch out for. And it's not just me saying this, because if you watch the futures contract, you got to watch what's called the basis, which is the difference between the futures price, or the price in 3-6 months from now, and the spot price, and the spot price is the market price right at the moment for delivery. You give us a bar of gold and you pay whatever the price is for it. And what we really see is that difference between the two has really shrunk. Like if you go back even as recent as 4 years ago, that basis rate was as high as like 5%. And remember, this is on gold. And gold, there's all this stock in the world, so you'd figure, it would be kind of high because, people would be willing to, kind of make a profit on it in the future. But what's happening is that basis rate, which is one of the things I check every day on the London exchange, is down to about 0.25. So there's very little difference between gold in the future and gold now, and the reason for that is people just aren't willing to put their gold out there, even if they can, make a clear profit on it in a few months, provided that the parties that they make the contract with have the gold. And what more and more people are realizing is there's too many claims out there for the same amount of gold. And, like you said, you can't counterfeit gold. It's very, very tough. That's why people used it as money, even when they're trading gold coins around. If you ever, I guess if there's any listeners that have never held an ounce of gold, see if you can find some. You can still go to like a local coin shop or something and just hold it. And it's dense. Like, it is 3 times denser than steel. It's about twice as dense as silver. It's denser than lead. So
it has a certain feel to it.
Yeah, and you drop it on the floor and you get a nice little ring and all that type of stuff. But at any rate, that's what is money. And the monetary system that I favor and what I talk about is using pretty much gold and silver as money. And that'll come about in the free market, but what I had actually had in place, and I have this all spelled out on my website I think it's under Platform and Issues, there's a presentation there. But what I had spelled out more or less is, the steps that we need to take to get back to a sound money, sound currency, and it's best to do this in kind of like an orderly, stepwise fashion so that things kind of don't get all chaotic. But and the government just keeps taking more and more actions, like the stimulus plan and even the FDIC. When they're closing down banks, they're actually not liquidating the bad debt. They're just kind of passing it on to other banks, and they're not doing their job. And
I'd like to touch back on the FDIC here.
Sure.
We've had 83 banks fail up to this date. We had a couple more this last Friday. I think we were at 81, and we're at 83 right now. And we're at least going to get probably another 100 in the last 4 months of this year as the winter falls on us and a lot of their green shoot talk suddenly withers away.
Well, we'll see. I predict we'll keep having more banks fail, but I would be hesitant to predict the number of banks. And the reason why, I guess another thing is I'm one of those guys that keeps a pretty detailed spreadsheet. So I've been following the FDIC for a while, and I think I'm actually going to stop now because all they're doing, starting actually just in this last quarter, is they're basically just going to be doing foo-foo magic the rest of the way to get everything to work out, because before they did have the fund and it was depleting, and what I would basically do is you could take the projected losses and add them up, and then every quarter you could actually calculate. Their accounting is a little bit funky, but you could actually calculate each month what their real losses were to the fund, because they have enough information publicly available in their quarterly reports to do that. They don't say it, they never say it directly, but you can actually do it. And, right now, it's just like, well, okay, the fund's out, but now we just have this magic money popping out everywhere. So really, my point is the FDIC it's a myth. They're built on a myth. And the myth is that, you have all these banks that are out there independent. And it's really not. And the reason why I won't predict how many banks fail is because with the advent of the Federal Reserve, especially following the 1980 Monetary Act, is the Federal Reserve is basically the one ring to govern all of the banks. And it binds them all together. And that's very, very, it's actually incredibly dangerous, because what it means is that, a single bank can't really fail. It can't really fail because the government's going to bail it out. But what it can mean is that when when it does go bust, and the entire American banking system, unfortunately, this is the truth, it's insolvent. And it's solvent because it did all this fractional reserve banking. Now it has no reserve.